Welcome back to the deep dive. Today, we are really cutting through the noise around retirement savings.
We're focusing on something that gives you, the investor, a ton of control.
The self-directed IRA. The
Yeah.
whole idea is you can move beyond just stocks and bonds and into things like, say, physical real estate or, and this is our main focus today, physical gold.
And do it all while keeping those powerful tax advantages. We're specifically looking at the rules for 2025.
Right. And we're going to break down the SEP IRA, the standard Roth IRA, and then see how gold fits into that whole STIRA wrapper.
Mm-hmm.
But before we get to the self-directed part, let's do a quick reset. What's an IRA? Just at the baseline level.
Right. So an individual retirement account is just a tax-advantaged savings vehicle. You've got the three main types.
Traditional, where you defer taxes.
Yep. Then Roth, where you pay tax now for tax-free withdrawals later.
And the SEPI, the Simplified Employee Pension. That's the one for the self-employed, for small business owners.
Exactly. And just to set the stage for 2025, the contribution limits for a standard traditional or Roth are $7,000.
Or $8,000 if you're 50 or older.
Right. And that's a good number, but it's a ceiling. We're going to see in a minute how the SC limits are just massively higher.
Which is really the mission today, adding that self-directed piece. This is where you go from just letting a brokerage handle things to really taking the wheel yourself. Okay, let's unpack this. What actually makes an IRA self-directed? How does that change the game?
So an STIRA, a self-directed IRA, it operates under the exact same IRS tax code. The big difference is that you, the investor, you make all the investment decisions.
So instead of just a menu of mutual funds.
Exactly. Instead of just stocks and bonds, you can look at assets like real estate, private placements, or, precious metals.
Okay, so the tax rules don't change, but the investment menu just explodes. That sounds almost too good to be true. If there's no broker, who's actually holding the asset?
Ah, that's the key.
I mean, it seems like a logistical nightmare if I want to buy a rental property with my IRA funds.
Well, this is where you have to understand the difference between a broker and a custodian. With an STIRA, you must use an IRS-approved custodian.
Like a trust company or a specific bank?
Yes, places like Equity Trust or Madison Trust, they physically hold the assets, they handle the admin. They're basically the IRS watchdog, making sure everything is compliant.
But they don't give you advice.
No, absolutely not. No investment advice. You choose the asset, they just execute the transaction and hold the title.
That's a critical distinction. And since there's no broker saying, hey, you can't buy that, we need to know the big red flags.
Yeah.
What are the aha moments that can get you in huge trouble with the IRS?
Well, the IRS is really focused on preventing two things: prohibited investments and prohibited transactions.
Okay.
Specifically, something called self-dealing. So prohibited investments, that's things like life insurance or collectibles.
So no fine art, no vintage wine collection in your IRA.
Exactly. Those are too hard to value. But the self-dealing part is where most people get tripped up.
Give me a concrete example. What's a transaction that could just blow up the whole account?
So the rule is you can't get any current personal benefit from the IRA's assets. The classic example is real estate.
Okay.
Let's say your SDIRA buys a rental property. You cannot use it for a personal vacation. Your kids can't live there. You can't even, go fix the plumbing yourself.
Really? Even that?
Even that. If you do, the IRS can call it a prohibited transaction. And if that happens, the entire IRA balance can become immediately taxable. We saw a case where someone used IRA funds to pay a small personal bill.
Yeah.
It triggered an audit that completely wiped out the tax advantage status of a six-figure account.
Wow. They are not messing around.
Not at all.
And just to be clear on funding,
Yeah.
you can only put in that $7,000 or $8,000 directly each year, right?
Right, for direct contributions. But a lot of people fund these by rolling over money from old 401ks.
From a previous job, for instance.
Exactly. That's a huge tax-free way to get the capital in there to start with.
Okay, so we have the SDRA wrapper and the rules. Now let's talk about the power here, starting with the two main vehicles, the SEP and the Roth. Let's start with the SEP IRA, the high contribution choice.
The SB is a total game changer for anyone self-employed. A freelancer, a contractor, small business owner. The contributions are made by the employer.
Which a lot of the time is also you.
It's also you. So those funds are tax deductible for the business. It works a lot like a traditional IRA in that sense.
And the big number for 2025 that grabs everyone's attention. We're talking a potential maximum of $70,000.
Up to $70,000 or 25% of compensation, whichever is less.
I mean, that's 10 times the standard limit.
It's an incredible ceiling. It's a tool for high-income entrepreneurs to shelter a lot of money very quickly. But There's a catch if you're a small business with actual employees.
Ah, what's the rule that gives people pause?
The rule is, if you have eligible employees, you, the employer, have to contribute the same percentage of compensation for them as you do for yourself.
So you can't just max out your own plan and give them a little bit.
No.
Yeah.
You have to factor in that cost for every single eligible staff member. And that calculation, that's often what stops a small company from going with a SEP.
That's a crucial detail. Now, we found a really interesting wrinkle in our research. The Roth SEP. What is that hybrid?
This is a huge insight, especially for high earners. The Roth SEP takes that massive $70,000 ceiling and combines it with the Roth's tax-free growth.
Okay.
But here's the kicker. Unlike a standard Roth IRA, the Roth SEP has no income limits.
Wait, hold on. You're telling me a high-income entrepreneur, someone who makes too much for a regular Roth, can use a Roth SEP, put in up to 70 grand, and get tax-free growth forever?
That's right. If you have the right business structure, it's an incredible path to lifetime tax advantage without those income phase-outs of the standard Roth.
That is a massive loophole, it feels like.
It's a massive opportunity.
So speaking of those phase-outs, let's pivot back to the standard Roth IRA. Even with its lower limit, it's still sort of the gold standard for that tax-free future.
It really is. The benefit is just so simple. You pay tax now, qualified withdrawals are totally tax-free later.
And the other huge benefit, no RMDs, no required minimum distributions.
Right. Not for the original owner in their lifetime. That gives you incredible flexibility, especially for estate planning.
But it has that income barrier. Let's nail down those 2025 numbers again.
This is the big constraint. For 2025, you can only make a full contribution if your modified adjusted gross income, your MEGI, is under $150,000 for a single filer.
And $236,000 for joint filers.
Correct. And once you go over those numbers, your contribution amount gets phased out pretty quickly until you're locked out completely.
Which is why that Roth SEP idea is so powerful. Now, if you are eligible for a standard Roth, there's also that 5-year clock you have to watch.
Yes, the 5-year rule. This trips people up all the time. It's about when your earnings become tax-free. That clock starts ticking on the day you make your very first contribution to any Roth IRA. So if you contributed for the first time in, say, December 2022, you still have to wait until January 1st, 2027 to pull out any earnings tax-free, even if you're already 59.5.
So timing is everything. Okay, we've got the vehicles down. Let's get to the asset that drives a lot of people to an SDIRA in the first place. Gold. How does physical gold fit into this structure?
This is where that SDIRA control really becomes tangible. A Gold IRA isn't some special type of account. It's just a self-directed traditional Roth or SEP IRA that holds physical precious metals.
Instead of stocks.
Exactly. Instead of stocks or bonds, your asset is physical gold, silver, platinum, or palladium.
Then we're talking about the actual physical metal, not an ETF or a mining stock.
Correct. The physical commodity. And the IRS has very specific rules about what kind you can hold.
The purity standards.
The purity standards. Gold bullion or coins have to be at least 99.5% pure. Silver has to be 99.9%. You can't just buy any old coin. You're buying specific approved bars or sovereign coins, like an American Gold Eagle.
Okay, let's tackle the storage issue, because this is where I think a lot of people get confused. I've heard stories of people thinking they can just, stick the gold bars in their safe at home.
And that is a huge, costly mistake. That is strictly prohibited.
Wow.
The rule is crystal clear. Any physical precious metals funded by an IRA must be stored in an IRS-approved third-party depository, secure facilities like Brinks.
And if you don't, if you take it home?
If you take physical possession of it, the IRS considers that a distribution. The full value of that metal becomes immediately taxable.
Sure.
And you'll owe penalties if you're under 59.5.
Okay, so that's a deal breaker. So how does the transaction actually work? If I want to buy a gold bar, do I buy it myself?
So the custodian manages the money, but you direct the purchase. You, the investor, find an approved precious metals dealer. You then instruct your custodian to send money from your SDIRA to that dealer. The dealer then ships the approved metal directly to your IRS-approved depository, where it's stored in your IRA's name.
So it's a three-way transaction, you, the custodian, and the dealer.
It requires all three parties working together. It's not a simple process.
That clarifies it a lot. Okay, let's bring this all together. You have the vehicle SEP or Roth. You have the wrapper, the SDIRA, and the asset gold. How do we figure out the best fit for someone?
Well, it all comes down to your income and your goals. The SEP IRA, that is unambiguously for self-employed people with high income, you want to maximize that huge $70,000 tax deduction right now.
And the standard Roth.
The standard Roth is for people who are under the income limits and who want that long-term tax-free growth and want to avoid RMDs. The Gold IRA, that's really an investment strategy. It's about diversification, hedging against inflation.
And just a quick check on RMDs. A traditional or SEP SDRA has them starting at age 73. But a Roth SDRA, no matter what it holds, is RMD-free for the owner.
That's right. The Roth structure always protects the owner from RMDs.
All right, so let's talk upside. Why go through all this extra complexity? What are the benefits?
Number one is true diversification. When most people say diversification, they mean different kinds of stocks and bonds.
Right.
Holding a physical asset like gold gives you a non-correlated hedge. It behaves differently than the stock market. And second, of course, is the tax shield. Deferral with a SEP, tax-free growth with a Roth.
And you can't ignore the sheer power of that $70,000 contribution limit in a SEP, especially if you compare it with the Roth tax treatment. That's a massive wealth-building engine.
It is. Plus, you get control. You get to choose your investments.
But this all raises the big question, right?
Yeah.
Is that control worth the hassle? We have to talk about the downside. These accounts are not for passive investors.
No, they are not. And the first thing that keeps planners up at night is fees.
Higher fees.
Much higher. SD IRAs have higher admin and custodial fees. And Gold IRAs add on mandatory annual storage and insurance costs.
Which can really eat into your returns over time.
They erode returns significantly over decades, yeah.
And what about liquidity? You know, if I need to take an RMD and my asset is a gold bar sitting in a vault in Delaware, how easy is that to turn into cash?
It's not easy. Liquidity is a major issue. You can't just click a button and sell. You have to contact the custodian and instruct them to sell the metal, wait for the whole transaction to clear. It takes a lot longer than selling a stock.
Making it much trickier for planning.
Much trickier. And then there's always the risk of those IRS penalties we talked about.
Right.
The complexity just means the risk of accidentally doing something wrong is higher, and the consequences, having your whole account become taxable.
Mm-hmm.
It's a huge risk. Due diligence is not optional here. It is absolutely mandatory.
Okay, so for those who have done that due diligence and decided this is for them, what are the key steps to setting one of these up for 2025?
It's a structured process.
Yeah.
Step 1. Choose an IRS-approved custodian that specializes in SDRAs.
Right. Step 2.
Open the specific account you need, SEP, Roth, or traditional, and make sure the paperwork says it's self-directed.
Step 3 is funding it.
Fund it, either with a cash contribution or, more commonly, a tax-free rollover from an old 401k.
Step 4, buy the asset.
Select and purchase your investment. If it's gold, buy the right purity and set up the depository storage immediately. And finally, Step 5, monitor and report. Stay on top of it with your custodian.
And our sources all say consult a tax advisor and start early in the year.
Definitely. To sum it all up, SD IRAs offer this incredible flexibility. But that flexibility demands diligence, patience, and a really deep understanding of the rules and the risks.
So what does this all mean? If you are a high-income, self-employed person, that Roth SF seems to offer the best of all world's high contribution limits, a tax-free future, and no income cap. So here's a question to think about. Given how restrictive the standard Roth is, should successful solopreneurs prioritize setting up a Roth SF to get that massive lifetime tax advantage? Or does the added complexity of a business retirement plan just outweigh the benefit? That's your deep dive homework. We'll see you next time.